Everybody's coming in.
Chester's here. Man.
You have all the good players here.
Yeah.
Everybody.
It's like
Kind of getting yourself down.
college setting on all of
It's 3 o'clock.
mine. Which makes me want to throw up in my mouth. College.
Coming together. It took a while. Except you know you're the professor. Are all your devices off so they won't make noise? Just go with it. No, it's not. Thank you. Wait a minute. No deal. All right, everybody. It's 3 o'clock. I'll call to order the Audit Finance meeting for January 25th, 2023. Present are council members Fears and Perkins, myself, Cindy Gray, Zach Walker, Adam Norris. We have special guests in person, Ron Luce, Chester Moyer. We've got the management analyst, Dr. Green. Kim Osborne's taking notes. Remind me of your name, sir, in the back. Lindsay, who is?
Nick.
Nick Kinney with PFM Asset Management.
Wonderful, Nick. Thank you. Oh, you're going to do our quarterly financial. Okay, cool. Anybody else presenting? No? That's everybody. Oh, and we've got council members, well, Steinmeier, and there was another one. McCandless is also here in the gallery. So, let's see. Nobody's absent. Additional attendees. Approval of minutes. Gentlemen, have my fellow committee members have a chance to review the minutes from the October meeting?
I did. I move we approve.
Second. With the motion and a second, no objection. The minutes from October 22nd meeting are approved. Since our folks are here in person, Ms. Gray, is there? Do we need to take anybody out of order today, and
Well,
for speed or efficiency purpose?
we follow the agenda.
Perfect. Then we'll start with Mr. Kinney.
Perfect. Come up here if that's all right.
Absolutely.
Gray, can you hear us as well? Okay. Speaking to this mic, okay?
Yeah.
Is that yours?
In QPR there. Yep. Just use this.
Yeah. Good try.
Perfect.
Awesome.
All right, good afternoon, everyone. Thank you for allowing me to present in person. It's certainly been a while. We're still finding meetings across the state where it's still the first time in person. So happy to be here. My name is Nick Kinney from PFM Asset Management. We're here to go over the quarterly review for the portfolio for City of Independence today. I work in Columbia, Missouri, but I'm from just down the road in Raytown. In fact, I was calling my mom on the way here, and she was trying to tell me all the buildings around here. And it's like, I know where I'm going, Mom. I'll figure it out. So happy to be here. I have Gray Lepley on the line with us today. She's on on video call. She's going to go through some economic highlights and the portfolio highlights. I'm here for questions. Gray's here for questions, and we'll just get right to it. So feel free, if while Gray's talking, if you have a question, raise your hand, and I'll help her coordinate those questions. So starting off, Gray, if you're ready, I think I'll move forward the slides here for you. I'm not sure we're moving forward here.
Use an arrow.
You're fine.
No, not doing
My
anything.
big head.
Gray, we can't hear you. Let's see. I'm gonna take it out of it. Okay, and then Gray's on video. How do we get her audio here?
Is her mic working? We never had a chance to test her audio, so.
Gray, I think we'll.
I'm gonna test her mic real fast.
Test your mic, Ray.
You want me? Okay. Oh, there we go. But no idea. Oh, Steve can do it. If he can fly a plane, he can fix the audio.
Let's see.
Get your license? Good for you.
He's got
Okay.
one.
Some people
Might have.
actually Gray here.
Sorry, I apologize. And can you hear us still?
Yeah, she can hear us okay. So she can't hear anything now. I think I just heard you very faintly. Did you talk, Gray? Did you hear it? Just keep talking. I can kind of hear you barely up here. I think you're just coming through on the computer speaker, Gray. Hold on one second. Cindy, did you pass the book those around? Does anybody else need a book? Gray, can you hear us?
I can hear you.
We're getting
That's too
there.
much stand right there.
It's a little bit like a concert right now, so we're working on the audio.
He'll fix that.
I have to ask. One more time.
Hear us, Gray? Still coming out of just the speaker. Or just the computer speaker.
One more.
One more, Gray. Still just the computer speaker. It's on mute. Try again.
How about this?
Yep, better.
Okay, that's something.
That'll work.
You talk one more time. Let's see if we can hear you.
Okay, how's this? Can everyone hear me a little bit better?
Yes.
All right. I think that'll work, Gray.
Okay. I'll try to project as much as possible, but hopefully not blow out the speaker while doing so.
Okay. You want to pull up the presentation? That's good to go. Okay. Gray, you want to start us off?
Yeah, absolutely. So we're going to go through some market information first, and then we're going to go and look at the accounts specifically and look at the portfolio and talk a little bit about what's going on in the portfolio and performance in that area. But to start, let's talk about the markets. The first page that we have here is really kind of just a summarization of what's happened most recently. There's a few points here. I'm not going to read through all of it, but of course, we continue to see high inflation. We're going to talk about that a little bit more in a second. Strong labor market. We're seeing the unemployment rate continue to be close to 50, 60-year lows at 3.5%. There's some concern about U.S. household finances because people are using debt more and not spending as much money on on discretionary items. And there's some concern about, of course, an economic downturn, which we will discuss. We'll talk about the Fed and what the Fed is currently doing in their rate tightening cycle. And then we will also talk about some of the volatile markets that we've seen most recently and what that has meant for portfolio yields, specifically your portfolio and your investments. So to start off, we wanted to give you a kind of an idea as to what happened over the quarter. If we go on to the next slide, you can see the 2-year Treasury yield. We're basically using this as a gauge to give an idea to how volatile markets were during the quarter. So we saw, volatility that we haven't seen in quite some time, especially in the bond market. And it was not just the bond market that was experiencing that, right? It was also, if you have any stocks or any brokerage accounts of your own or followed that type of news, you'll know that the stock market was also extremely volatile. And I don't even think this chart really gets you to the entire crux of the issue, because even this is showing, points in time at the end of the day, what yields were on the 2-year Treasury. If you looked at what happened intraday, so between, trading opening and trading closing, we saw wide swings really across the board in terms of Treasuries and all types of fixed income. But a few things that we wanted to point out here, we continue to see rates remain sensitive to two specific things, and we saw that specifically over the quarter. First thing being CPI and inflation information in general. So you can see the October 13th CPI reading came in, and we saw consumer prices actually higher than expected. So they hadn't abated as much as the Fed would have wanted at that time. We were still in the 7% range, which is much higher than the Fed's preferred target, which is actually 2% average inflation, so much higher. As a result, we saw rates back up because the concern is that the Fed would then have to raise rates even further, so that was being priced into the market. If we go to November 3rd, we had information from the Fed. The Fed had their meeting in November, and they talked about, we saw more of a hawkish stance from them. And so part of that resulted in rates moving even higher as well, because they talked about the fact that they might need to raise rates further to combat inflation. When we got the CPI reading just a few days later, however, we actually saw some of it start to come down. Some of those readings start to come down. Some of the month-over-month information come down as well. And so maybe the market decided that we're not going to need to raise rates as much as the Fed says. So we saw rates come back down. And then when November 30th rolled around, and Jay Powell, the Fed chair, confirmed that upcoming rate hikes were going to be smaller than the 75 basis points that we had seen for the past few rate increases. That was a signal for the market to kind of come down. So again, you see this kind of across the board, but this we just isolated the 2-year to give you an idea as to what the landscape really looked like during the quarter. If we go into the next page, let's talk about one of those topics that I just discussed, which is inflation. So inflation, there's a bunch of different metrics that you can use. The one that we have shown here is CPI. Nick, we're on the next page if you don't mind going.
I'm trying to move it over here.
Okay. Well, I'll talk through it for a few minutes. So there's a few different metrics for inflation that are used. The one that we prefer to, or the one that's most commonly kind of sourced or discussed out in the ether, out in the news and the media, is CPI, so Consumer Price Index. It's essentially just a basket of goods and services, and what the change in price for that same basket of goods and services is from month to month or from year to year. So what we're showing here is the different contributors to that basket, to those readings over time. And we're showing back to May of 2020, when obviously inflation was extremely low because we were in the depths of the pandemic, and people were not going out and spending money, and we were seeing fuel costs be extremely low, so they were a detractor at the time. Let's move more towards where we are now. If you look at the peak that we saw, that was in June of this year. We peaked at 9.1% in terms of CPI, which is extremely high. As I mentioned, the Fed prefers something more around 2%, so just a little bit off of that. But what were the contributors? You can see the green, which is fuel and energy, really was a large contributor for a long period of time at the beginning of 2022. That has since tapered off, and you'll probably have noticed that, if you have a car and you're going and driving around and buying gas and other types of fuel like that, that those prices have come down to a certain extent. The yellow is food, and you'll notice that it has continued to creep larger and larger and larger, most recently with headlines about eggs costing way too much money. I have read a few different articles now where they've cited, information from an egg market reporter, and I didn't know that was a job that someone could have, but apparently that's a thing. So that's kind of interesting. It looks like if you take eggs out of the equation to a certain extent on a month-over-month basis, it looks like food prices are starting to come down to a certain extent, or food inflation is not rising as fast as it was before. The next one is goods. So those are things that you and I would just go out and buy. You can see that those really increased at the beginning of 2022 and have started to decrease pretty significantly. And what has taken its place and has kept inflation so high is the dark blue bars, which are services. So people are continuing to spend money on services. It's no wonder that services, which of course is very wage driven because it relies on an employee to do some sort of service, to do some sort of work, because it is so wage driven, that those have continued to move up. That is continuing to keep CPI and just generally inflation at a much higher level than the Fed would like. Now, the number that we have here for November is 7.1%. We did receive December's number at 6.5%. So again, we're continuing to see that trend go in the right direction, which is good news. And we are expecting, if we look at the Bloomberg forecasts here for the next few quarters, that will continue. That trend will continue to move downward. But you can see that even by the end of 2023, we're still not expecting to be back to that 2% target. So what does that mean for the Fed? If we move on to the next slide, you can see some information on the Fed. This is called the Fed dot plot. You may have seen this before, but if not, or if you have and you don't remember, I'll give you a quick refresher. Each of these dots represents a voting member of the FOMC, of the Fed. And at each of their every other meeting, essentially, that they have, they put this dot plot together, this chart. What it is saying is their opinion as to what appropriate monetary policy or the level of appropriate monetary policy will be at the end of each of these years. So by the end of December of 2023, they expect, when this is put together in December, that appropriate monetary policy will be between 5 and 5.25%. We are currently at 4.25% to 4.5%. So that would mean ostensibly 3 more quarter percent rate hikes at this point for this year before we get to that point. If you look at December of 2024, you can see it obviously comes down, but it does not come down to where they expect long-term rates are going to stay. So it comes down to about 4 to 4.25, and there's a much larger dispersion in terms of where the voters actually thought appropriate monetary policy would be. You can see one of the voters, in fact, continue to expect or project that rates would need to be between 5.5% and 6% still. So again, there's a much larger dispersion as we get further out. December of 2025, even lower, and then longer term, the expectation generally is that 2.5% is kind of going to be the sweet spot for the overnight Fed funds target rate. But as a result, of course, if we go on to the next slide, this is showing what has happened in terms of the Fed moves since the beginning of last year. So recall where we were at the beginning of last year. We were basically at 0% interest rates, right? We had 0% yields across the board, or very close to 0% yields across the board, because of the fact that the Fed had to cut rates by so much during the pandemic to make sure that, the health crisis did not become a financial crisis as well. So they started to raise rates as a result of the fact that they needed to combat inflation, which seemed to be stickier than they originally thought with the supply chain issues that we saw, et cetera, et cetera. And you can see they started off at 25 basis points, which is the typical amount that the Fed kind of increases rates by. Now, we saw those 4 75 basis point rate increases during the year, which is basically unprecedented. So the last time we had seen a 75 basis point increase, I believe, was in the early 90s. economies. And so seeing 4 back-to-back, again, somewhat unprecedented. You can see in December that they did change their tune to a certain extent in that they said they were going to slow down rate hikes moving forward, and so only increased by 50 basis points instead of 75, because they said they're at a place where they want to start to basically fine-tune what needs to happen moving forward in terms of inflation. They started to see some of those inflation numbers come down, and so they don't want to, put their foot too heavily on the gas, as they already have to a certain extent. They want to be able to move with the data, be data dependent, and really make sure that they're doing the right thing, because they don't want to throw the economy into a recession. It may be inevitable at this point. We'll talk about that momentarily, but that is their goal. They do not want to throw the economy into a recession. If you look forward in the light blue, this is showing what the market expectations were. This is as of the beginning of January, but I will tell you it's generally the same. The expectation is that we are going to see a 25 basis point increase. That's actually at the meeting next week on the 31st and the 1st of February. And then we're expecting another 25 basis points in March. And then by the end of the year, the market is projecting that we're actually going to see the Fed start to cut rates. The only difference between what I'm showing here and what is actually occurring currently in the market is that this first 25 basis point cut is expected in September, so earlier than what this chart is showing here. So essentially what I'm telling you is that what we're seeing is the Fed saying we're going to raise rates to 5, 5.25, we're going to keep them there for the duration of the year, and the market is saying, I'm not so sure about that. I think we might be actually getting to a point where the Fed's going to have to cut rates to get things back on track without throwing the economy into too deep of a recession, and that they're not going to need to keep rates as high for as long. So it's a little bit of discrepancy that's kind of interesting and has been driving yields in general in the markets. The next page talks about the year in general and what happened. I talked about the Fed raising rates already by quite a bit. What was kind of interesting is shown on the right-hand side. This was a year of awful returns. There's no pretty way to say that. There's no, silver lining really there. Unfortunately, across the board, no matter what type of investment you are invested in, unless you were in cash, which you can see is the fourth one over on the right-hand side, or oil. Of course, that's not permitted by policy. But if you were invested in any other asset class, you basically saw a negative return. The reason this is such a strange phenomenon is because typically when you see stocks underperform, you see bonds outperform, and vice versa. If you see stocks do really well, you might see bonds do poorly. But this was a year where we saw such a change across the board that both did really poorly. And so the reason behind bonds specifically doing poorly and having these very negative returns is the fact that rates went up as much as they did. With the Fed raising rates basically by 425 basis points, 4.25%, what that means in bond world is that as rates rise, market values fall. And so those market value declines resulted in negative performance, negative total returns in those types of portfolios. Again, when we look at this, we're going to get back into your specific performance in greater detail, but I would look at that 1 to 5 Gov Corp as kind of a proxy. Of course, we're not buying corporates in your portfolio, but you can see that was negative 5.3 just for the year alone. If we go on to the next page, I mentioned this, and I think it's important to talk about what is going on in terms of a recession. We're in this strange situation where what I've done on the left-hand side is put together kind of a matrix that shows where some of the different economic indicators are pointing. And you can see the labor market, for instance, at 3.5% unemployment, way more jobs available than there are people unemployed. So a lot more a lot more demand than there is supply. That is not really typical of a recessionary situation. Typically, when we see a recession happen, we see unemployment go up by a pretty significant amount. We haven't seen that. We've seen it continue to be very low. Moving a little bit further over, into the intermediate area is retail sales and consumer. Now, I would put, if I were to make this today, I would put retail sales on top of consumer right in the middle. And that's because the most recent retail sales data that we got this past week was not as positive as was expected. We actually saw some declines in November and December. The consumer is in this place where, again, they're buoyed by the fact that the labor market is so strong and there has been pretty high wage inflation, but they're also being, cut into, their income is being cut into by inflationary pressures and the fact that the money from stimulus during COVID really has run out for the most part. Those savings that a lot of people have is gone, and people are now starting to spend more on credit cards and get into more debt. So that's why I have that in the middle. And then all the way on the right-hand side, we have a whole slew of things, unfortunately. Manufacturing is in contraction. At this point, we are very late in a rate hike cycle because we're up as high as we are. Inflation continues to be problematic. Housing is in a recession. And the inverted yield curve, what is that? It's essentially saying the front end of the yield curve, so anything from, let's say, 0 to 1 year, is much higher yielding than anything further out the curve. So 2, 5, 10, even 30 years, much lower than the front end of the curve. That's not typical. Typically, what you see is a forward sloping or upward sloping yield curve where shorter term yields are lower than those that are further out the curve. When you see this type of inversion, which we'll look at in a moment, that has preceded every single time we've had one of those in the past 8 recessions. It has preceded a recession. So it's 8 for 8 for being an economic indicator. That's not a ton of data, right? If you think about sample size and statistics, but it is something that people are obviously very concerned about. So on the right-hand side, you can see GDP forecasts moving forward. The expectation is that at some point during this first, second, third quarter, we're going to see negative or very muted growth. And so some sort of a slowdown, hopefully not a deep one, but rather a shallow, quick recession, shallow, quick slowdown. And then very quickly after that, we're expecting GDP is going to grow by the end of the year, going into 2024 at a pretty strong clip. Let's pause right there for a second and see if anyone has any questions before I continue on with the market section.
Any questions, everyone, specifically on rate hikes or what the Fed is going to do? Is all that pretty clear? Go ahead, I think, Greg. Go ahead.
Okay, great. So this slide is exactly what I was talking about with the yield curve inversion. You can see it very clearly on the right-hand side. Where we were in December of 2021, so going into 2022, is the dotted blue line at the bottom. So rates were very low. Again, you see this upward sloping yield curve. Now we see the dark blue line at the top is where we were as of December 31st with this yield curve inversion. So higher yields in the front, lower yields in the back. There's a few different reasons for that. First of all, we see the front end of the curve continue to move up in lockstep, essentially, or be anchored by the Fed's movement. So as the Fed continues to raise rates, those front end rates have to go up. The reason we see rates in the longer end or even in the belly of the curve in that 1 to 5, 2 to 5 year space be lower is for a few reasons. First of all, it's pricing in some sort of economic slowdown. It's also pricing in the inflation expectations for inflation to go down, because we are starting to see that. And it's also pricing in the fact that the market expects the Fed to start cutting rates at some point. So all of that is being factored into that area of the curve. So it's not expecting that we're going to have, long-term rates at 4.5% to 5% forever. Essentially, the market is saying, yes, we think there will be some rate cuts moving forward. But that huge change that you see across the board from December of 21 to December of 22 is what has resulted in negative returns in portfolios. If we look at the next page, this kind of breaks that down a little bit further and talks about what is the actual, how do we calculate return? It's based on two things. It's based on income, so the actual coupon or the yield at which you bought something, and the income that's being spun off as coupons and payments over time. And it's also made of price return, which is essentially beholden to where markets are. So when market values go up and down, that's what price return is. Well, you can see we started, if you look all the way on the right-hand side of the left-hand chart, you can see for 2021, we started at such low yields. The income in portfolios at that time was so low that even the small change in yields going up and creating negative price return resulted in total returns being very muted. Now, we started 2022 from a little bit of a higher spot, and that's why you see that blue bar be a little bit higher, but we saw this huge run up in yields. So that price return component was a huge detractor. So you can see that obviously price returns for this is showing 1 to 5 treasuries, were somewhere in that 5% range. The reason we have this green dot showing 2023 starting yield at 433 is that is essentially saying where are we starting 2023? What are we expecting in terms of income? The income expectations for this year are much higher, and really the income is what drives performance over time. So if you look at the performance all the way back to the year 2000 on this chart, you can see that really what's driven it is that dark blue bar across the board. And so we're expecting that because rates are so much higher now, because you can invest in yields that are much higher than they were last year or even a few years ago, the highest they've been in really 14 or 15 years, to be honest with you. We expect that price return is going to be income return is going to be a big component of what we see in performance in 2023. Last thing I would say on the next page talks about different types of sectors. We do not invest in anything but federal agencies and treasuries in the portfolio, so you don't have to look at the rest of these. I think it's information, it's interesting information, but essentially what we're showing in the federal agency space is that there has been some more opportunities recently, but unfortunately we've been in a situation that's been kind of an anomalous situation in that federal agency securities have had a little bit less liquidity in terms of buying and selling. So typically they're extremely liquid. They sell at, yields that are right in line with treasuries or very close to treasuries. What we've seen recently is a little bit more incremental spread, so incremental value that you can get in those securities. But when you go to sell them, if you had to sell them, then kind of you don't get the value that you would typically get. And so that's one area that we've looked at, we've been evaluating, but we haven't necessarily been purchasing securities. Final thing in this section is really just showing quarterly returns, and that is on the next page. This shows, again, from this quarter specifically, we did see rates in that 1 to 5 year space fall to a certain extent. So that's why you're seeing positive performance. So I think you'll be excited that we're seeing some positive performance this quarter. This past year, as I mentioned, as we saw, for 2023 in general, 2022 in general, it's been pretty abysmal, but we did see some positive returns this past quarter. And then finally, fixed income sector commentary. I'm not going to read through all of this, but essentially what the things that I just mentioned, we're going to continue to look at treasuries and federal agencies as rates are extremely high in comparison to where they have been historically, and we're going to continue to evaluate opportunities when they come across our desk. The next page shows the same thing, just graphically. So again, you can see treasuries are somewhat neutral to somewhat attractive, and then agencies, again, which is what we were purchasing for the portfolio, really in that neutral space. So that takes us into the portfolio itself. I'm going to pause again and see if anyone has any follow-up questions before we get into this section of the report.
Questions? Great, I think you're okay to continue.
All right, great. So this first page is a summary, goes through not only what is in the managed account, which is about $109 million, but then also what is in the pool in MOSIP, which is about, at this time as of 12/31, was $625,000. So that's a total of about $110 million. The sector allocation on the right-hand side shows that, that mix of different types of investments. And I mentioned gray is U.S. Treasuries, and then the blue color is federal agencies. So what do I mean by federal agencies? I'm talking about Fannie Mae, Freddie Mac, Federal Home Loan Bank, names like that. They have an implicit guarantee by the U.S. government. They're extremely highly rated, just like the U.S. government as well. The maturity distribution on the bottom shows where we currently are in terms of maturities coming up. So you can see that there's quite a bit in that 0 to 1 year bucket, 6 and 8.5 and 6.8, and then 1 to 2, 2 to 3, quite a bit as well. A little less in the 3 to 4 and 4 to 5 year space. And I think we're quite a bit short of the benchmark, and we can talk about that briefly as we get a little bit further out in the report. The next page goes through, again, similar information. On an amortized cost value, of course, we're at 114 million. Market value is 109 million. I mentioned that already. And there's accrued interest, of course, coming in through payments, and coupons that come in as a result of the different securities that are in the portfolio. One thing I do want to mention on the right-hand side is this discrepancy or this difference between yield at market and yield on cost. So yield at market essentially is where you could recreate the entire portfolio today. So let's say we took all of the securities that are in your portfolio and we just duplicated the portfolio and created a new portfolio with the exact same securities. As of 12/31, that yield would be 4.49. Where we bought the securities over time, though, because we've invested at different periods in time, is a 1.33. So again, because we bought securities in 2019 and 2020 and 2021 and 2022, that blended yield at cost is a 1.33. So there is this big difference between the yield at market and the yield on cost, which is why when we talk about unrealized losses, that's where those are coming from, right? Because if you were to sell a security, you're going to realize a loss. However, you would be able to invest back into yields that are much higher than where you're holding those securities currently. But that's kind of that situation, that story there. The next page goes into issuer diversification. Again, we have two sectors in this portfolio, both governmental in nature. And so we have treasuries at 57.6%, and we have agencies at about 42%. Again, those names, Fannie Mae, Freddie Mac, Federal Farm Credit Bank, those types of things. Looking at the left-hand side, you can see the portfolio effective duration. That is a measure of interest rate risk. So we are at 1.93 years. The benchmark that is the portfolio's benchmark is 2.48. You'll notice that is very different. We want to be somewhere in that 95 to 98%, but we also don't want to subject you to realizing a whole lot of losses in order to get there. And so we've been in this position of not, wanting to realize those losses before we have a conversation with you further about how we want to handle this. And so the duration is effectively just drifting to a certain extent at this point. So that's why we're seeing that big difference between 193 and 248. Yield at cost, we talked about. Yield at market, we also talked about. The portfolio credit quality is extremely high at AA. You may say, treasuries are the safest investment out there. Why is it not AAA rated? That's because the Treasury and the U.S. government was downgraded a few years ago to AA. So Microsoft apparently is higher rated than the U.S. government. So just so you're aware of that, you're not looking at that and wondering why that is the way it is. That's what's happening. The duration distribution in the left or the bottom right-hand corner goes through and shows you exactly how we are so short of that benchmark. We have a much larger portion in that 0 to 1 year bucket than the benchmark itself does. And then we have less in that 3 to 4 and 4 to 5 year space, especially, than the benchmark does as well. Next page goes over issuer diversification. I think we're pretty well diversified by issuer. One thing I would note is that Federal Farm Credit Banks, which is at 2.5% of the portfolio, does not come to market as often, and so you will see that continues to be a much lower amount. Federal Home Loan Banks does come to market more often, but historically, Fannie Mae and Freddie Mac have really been the different agencies where we've been able to find a lot of value. This page shows the total allocation kind of over time and what has changed. I will say there has not been much change over the past quarter or so in terms of allocations. You can see that they've remained quite steady. And that's somewhat purposeful. Again, we don't want to be selling out of securities and realizing a lot of losses and having you have to, book those losses. One thing I would also mention is that we continue to see some value in agencies above treasuries. I mentioned that earlier. So we don't think that that is a bad place to be for sure. Again, extremely highly rated, extremely highly liquid, the entire portfolio. So we're happy with that. This shows portfolio activity over the past year. Not a whole lot to write home about, but I would say in terms of the reason we don't have as many agency purchases is because agencies, while having some value, again, I mentioned, have some of those liquidity concerns that hadn't been there previously. And so that's been something that we've been somewhat aware of, and therefore we've been focusing more on treasuries because, again, treasuries themselves have been in extremely high yields, very attractive yields for what we've seen historically. And then the final page shows, one of the final pages shows performance. And again, as I mentioned, this quarter we did see some positive performance. So all very excited about that. It's a lot easier to have conversations with clients, I will tell you, when there's positive performance than when there's negative performance. Now, for the past 3 months, you can see the interest earned, which is, again, the coupons and the other income that's coming into the portfolio. The change in market value is because rates came down in that 0 to 5 year space. And because of that, we saw market values go up. And so the total dollar return for the past 3 months was just shy of $1 million. The benchmark or the portfolio returned 83 basis points versus the benchmark at 95 basis points. Why is there a discrepancy there? It's because of the fact that the portfolio is currently shorter than the benchmark. So the benchmark was able to realize more of that price drop, or excuse me, that yield drop than the actual portfolio was able to. If we go back a little bit further through the year, in the past 3 years and since inception, you can see that back to since inception, we have seen a total dollar return of about 4.5 million, and benchmark has beat, or excuse me, portfolio has beat the benchmark handily by 20 basis points. The next page goes into where some of these return numbers are coming from. I talked about this previously when we looked at the market section of the report. But essentially what we're showing here is income return. Again, that's coupons and coupon payments coming in gray. And then the blue is the price return, so the difference in market value. So again, market values went up this quarter, and therefore you're seeing that blue bar be positive. The past few reports, if you looked at them and compared them to this one, you would see that blue bar actually be on the negative side. So again, that's where you're seeing that positivity come from. And then that just shows on the right-hand side how that all adds up to your specific performance over the quarter. Last exhibit is accrual basis earnings, and we're really excited about this, and we hope you are too. Again, that interest earned for 3 months, 405,000. Change in amortized cost, just a slight change there. Total earnings at around 400,000. But then again, if you look all the way back to since inception, very strong returns and earnings of 10.4 million. And we expect those to continue to grow, especially as we are able to invest in higher yields over time. I'm not going to go through the rest of this. There's a lot of other information in here about transactions and holdings and all of those types of things, but I'm happy to answer any questions you have.
Thank you, Gray. We'll stop there real quick. Any questions about the portfolio, the economy at this time? Gray, any questions at all?
I do.
Yes.
Couple of things. So I'll preface this by saying I'm fairly new to the council and new to this committee. So this is the first time I've really seen your report. The question I would first have is, what are our limitations relative to investing in the public sector? Because I'm familiar with other settings and on other investment committees, but I'm not sure what our limitations are here. Second question, can you just kind of outline for me the difference between the MOSIP and the MOSIP managed accounts? Those would be my first two questions.
Great.
Sure. Nick, do you want to talk about MOSIP managed, and then I can talk about the first part?
Yeah, so the MOSIP account, sorry, I'm getting some feedback here. MOSIP account is our local government investment pool. The investments inside that are made up of Missouri state statute approved investments. So, Gray, you can touch on some of those because it kind of tails with what the City of Independence is able to invest in. But it's more like a money market account, whereas the other ones are true securities investing directly in those. Okay. So a little bit aside from the managed account that Gray can talk about here.
Yeah, absolutely. And so when you ask about, what does this look like in terms of public funds and how they can be invested, your IPS specifically allows for Treasury securities, as we talked about, which is why we're investing in so many of them. Also allows for agency securities, so those things I talked about, Fannie Mae, Freddie Mac, et cetera. It does not allow for much outside of that, to be honest with you. There are some other stipulations in here, repurchase agreements. That's not really something that we typically would purchase in a portfolio like this. This is more of a longer term portfolio, and therefore repurchase agreements don't necessarily fit within that investment horizon. I would say, we work with clients across the country, and so we do have a lot of clients that are able to purchase other types of securities. It just so happens that the IPS at the city is a little bit more restrictive, and that's why you're seeing treasuries and federal agencies only.
And Gray, would you say, just a follow-up to that, when we can review an investment policy statement for a client, would we be able to recommend other potential avenues to add into there? How often do we do that in your experience?
So I didn't hear all of what you just said because I heard some feedback. But yeah, so when we do go through and review, that is one of the things that we look for, other opportunities, if there are any, to make sure that you are as safely as possible and within the objectives of safety, liquidity, and then return, making sure that we are investing and helping you invest in the widest available universe of securities and investments possible.
And that's the exercise we've done with staff previously. We can continue to do that. I would say we do want to follow Missouri state statute. That's first, important: safety, liquidity, then yield. There was a ballot issue on the Constitution, or a possible ballot issue that would amend the Constitution that came up in November that was defeated, that would allow cities, counties around the state to invest in municipal securities, amongst other things. That did not pass, so we're not able to do that. So kind of tails into some of that sort of thing, but if it's something we want to review again, we're happy to help. Yeah. And that's the investment policy set by the city. Okay. Sorry, Greg, I got feedback out there. Good question. Any others?
I'm assuming you're not probably able to do this, but are you able to make any projection as to when we might come back up as far as to the amortized value?
Predictions are Gray's specialty, I'd say.
I wish.
Greg, could you just talk about a little bit about what we would expect in a maybe stable or decreasing rate environment?
Absolutely. So what we've seen this past year, as I have now probably talked about ad nauseum, and I apologize, is that we've seen interest rates move up precipitously, right, over the past year. And so we saw market values decrease. What we are expecting as we move forward with the Fed kind of normalizing policy to a certain extent and stopping these really huge interest rate hikes, maybe fine tuning here and there, we're expecting that, again, rates are going to start to gravitate lower. As those rates start to gravitate lower, what that results in is positive returns. So you saw that just from this quarter because there was a slight change in yields. But again, as we move forward, when you have securities that were purchased at much higher yields, producing much more income in general, and then you also have yields falling, if you see that kind of an environment, what you often see is outsized performance. So just to give you an example, during 2020, for instance, when we saw the Fed cut rates as a result of the pandemic, we saw amazing returns in fixed income portfolios because of that sharp decrease. We don't expect a sharp decrease the way that we saw in 2020, in March of 2020, and throughout that period of time. But we do expect that rates will start to gravitate lower, and you're going to see what we call roll down and price appreciation over time of securities. So we're basically, what I'm trying to tell you is this past year was an anomaly. We are not expecting that we're going to see terrible negative returns like we did this past year moving forward. We expect that since we're starting at a much higher yield point, much higher income level point, that we're going to see much more positive returns moving forward.
And again, an unusual year with both stocks and bonds seeing negative returns as well. We would not expect that going forward. I will say we'll be working with staff probably over the next quarter to make some changes to get closer to that benchmark. We'll communicate that. Thank you. Communicate that with them and just work with them as we transition from the way the portfolio was during the pandemic, coming out of that to be in a more normalized rate environment. Thank you. A lot of info. We can throw more, we can throw less, but we'll talk to you for next time and make sure we get the information you want. Any other things at this point? All right. Okay. Great. Thank you so much. I appreciate you dialing in today.
It was nice meeting all of you. Have a good rest of your day.
That was excellent.
Thank you.
Thank you very much. I'm glad we have one person up here who understood about 70% of that. No Bitcoin? We can't buy Bitcoin, right?
We're working on it, but no, I don't think,
Yeah. Okay.
I don't think that passes the Constitution yet.
Gotcha. Okay. Chester, are you next? Annual audit review. Thank you, Mr. Kenny.
Thank you. Thank you all for having me.
Try that. Yep. Okay. Thank you, everyone, council members, for having me here. My name is Chester Moyer. I am the audit partner for Reuben Brown, which is your external auditor, independent of the city. And I'm here to present the audit results for the June 30, 2022 year end. And this presentation includes the communications that were required to communicate to governance as a part of this audit process. So I did want to start just as a reminder of what we're doing for the city, specifically in that we're giving an audit opinion on the financial statements for the city. Our perspective is to provide assurance that there are no material misstatements in the financial information that's being reported. We also provide a report on compliance and internal control for the city. That's really a byproduct of the audit procedures that we provide. We're not giving an audit opinion on controls, but we are communicating to you any instances of internal control problems that we would see. And then finally, we're also auditing the federal funds that the city receives. We call that a single audit. So there are special compliance requirements around the federal funds that are received, how they're expended, and we perform those procedures this year for the city as well. The limitations on what we're doing as an audit, just as a reminder, we are using materiality when we perform our audit. So we're providing reasonable but not absolute assurance that there are no material misstatements in the financial statement. And we're not performing our audit. It's not designed to detect fraud. If we do detect fraud as a part of our procedures, again, as a byproduct, we're required to communicate that to you as the governing body, and we don't have anything to report in that area. So to get to the more formal communications here on what I have pulled up on this slide, management does have a big role in this process. These are their financial statements. We're auditing them. They're the ones that are making the selections on the accounting policies, as noted in that first bullet point, and we're evaluating them to make sure that they are appropriate. And those accounting policies are listed in the footnotes. During the year, one accounting policy did change for the city. It did have a significant impact on the financial presentation. So there was a new standard around leases. The city has activity where it's both a lessee making payments out as a participant in a lease, and it's also a lessor where it's receiving payments. And this standard required that activity to be presented within the financial statements and not just in the footnotes as it was previously. This information is included in notes 1 and 7 of the financial statements. the city does have proportionally more activity as a lessor. It has a few agreements that are much more significant than it does as a participant, as a lessee. So that change was implemented by the city. It was done very well, and those financial statements reflect that change. And to turn to the next slide here, the city also has financial accounting estimates included within the financial statement. So not everything, for example, can be vouched to a bank statement. There are numbers in there that are estimates. Some of those estimates are included here. The most significant two, I would say, are the last two that are on the left side of the page. So you're using actuaries for your pension plan. You're using an actuary for your other post-employment benefit plan. And there are a lot of estimates included in that calculation. And those estimates have a big impact on the ultimate value of the items that are included in the financial statement. So we do, as our audit process, evaluate those estimates and determine them to be reasonable in relation to the financial statements as a whole. And then also, not only are your financial statements the numbers that are presented on what we would call the balance sheet or the income statement, but also the footnote disclosures are important as well. And we highlighted 3 here that we believe are most important to the users of the financial statements. So your deposits and investments. We just had a nice presentation on what you're investing in through PFM, the tax revenue for the city, and then also the long-term obligations that the city has and its commitment to pay those off. We are also required to communicate to you any misstatements that we encounter during the course of our audit. So some misstatements are corrected and some misstatements are left uncorrected. We're required to report both of those to you. If a misstatement is uncorrected, we call it a past journal entry. That just means that management has decided it's not material to the financial statements. We evaluate that assessment and in this case determine that to be accurate and reasonable as well. So at the bottom of this slide, we have one adjusting entry that was made where our audit procedures detected a misstatement during the audit, and the management did make this change. This is something that happens in a lot of governments where you have a construction project, the invoice is received after the period is closed, but it relates to construction activity that happened before the end of the period. You have to make a paper accrual to get that put on the financial statements, and our procedures identified that, and that adjustment was made. This slide has a lot of activity. I want to walk through the 3 items on here that we consider to be, or what we would classify as uncorrected misstatements. So the first one at the top, big picture, is that the city had a revision made to its calculation in the Stay Well Fund for medical and pharmacy unpaid claim reserves. That revised report came in right as we were getting ready to issue the audit. And instead of making the change, management determined that let's pass on it. We'll present the change as being in the uncorrected misstatements. And we also agreed that that was not a material misstatement to the financial statements to pass on that adjustment. The second row there is a reflection of the implementation of this new lease standard where the city had a presentation for one of its leases done on more of a cash basis because that's the way everybody is reviewing the lease and those payments as they come in, and that's how it's being reported really throughout the city. The GASB would say, well, really a portion of this is interest, a portion of this is principal. We make some kind of paper calculations again. Those weren't done as a practical expedient really by the city, so this just reflects, well, this is what the GASB would say should be reported versus what the city did report. And then the third item is it's kind of below the black, it's in between the 2 black boxes, is an error that the city management identified themselves. There was an accrual that was building up over time. This was not identified as a part of our audit process. It was presented to us. That change was made, and a portion of it applied to a prior period. That portion that applied to a prior period is what we're identifying as the error. And again, we determined that also in agreement with them to be immaterial to the financial statements as a whole and its opinion unit that it resides in. So we're also required to communicate to you a couple things that are unique with our audit report. So the only thing in those financial statements that's several hundred pages long is our 4-page audit report or so. And within that audit report, we do have an emphasis of matter because the city did implement the new lease standard. And then we also make a reference each year to the fact that the Cable Dahmer Arena activity is audited by another auditor. We receive their information, we have communications with them, bring that information into the audit, and we are relying on other auditors for that small portion of the city's financial statements. The financial statements themselves are quite thick. You have a copy of them on your desk there. What we audit is kind of in the middle. It's the basic financial statements, the balance sheet, the income statement, the footnotes. After that is statistical information. Before that is the management's discussion and analysis and transmittal letter, things like that. We don't audit that information, but we do read it to make sure that it's not inconsistent with what our audit procedures identified. And then also, like I said, part of a byproduct of our audit is that if we come across any internal control matters that we believe are significant deficiencies or material weaknesses, we are required to communicate those to you. And we've done that in the past. This year we have no matters to report within a government auditing standards internal control letter to you. Like I said, also, you engaged us to perform the audit of the federal funds. We call that the single audit. So those are the federal funds that the city is receiving. Last year, the city received, again, 2022, the city received and spent about $15 million of federal funds. You group those together according to the way the federal government requires those to be grouped. So we audited the American Rescue Plan Act, which is the first bullet point there on the right side, and also the Federal Transit Cluster. The American Rescue Plan Act expenditures in 2022 were about $9.5 million, and the Federal Transit Cluster was close to $1 million. So we audited about 2/3 of the federal expenditures of the city. We follow the framework that the federal government requires of us in order to determine which programs to be audited. In both of those cases, either its size, like with the American Rescue Plan Act, and its newness to the city, elevated it to be required to be audited. And the Federal Transit Cluster was both its size and the fact that it was supplemented with some COVID-19 funds, so it was determined to be high risk by the federal government. Again, we had no findings identified, either compliance or control, with these audits of the federal funds. Again, there have been in the past, but not this year. So a good improvement there. We have some recommendations, both from a prior year status as well as some current year observations. So these are not elements that are required as a part of our audit, but they're really, what are we seeing as auditors as we dig through things and talk with management? The first item we have is really a continuation from a prior year of continuing to develop and build out the accounting, finance, procurement functions to improve workflow, distribution of responsibilities. When we began the audit, there was, and this was our fourth year for auditing the city. In our first year, there was, I would say, a great constraint on a few people and trying to get the functions done within the accounting department. And that through this process, there's been an expansion of those roles. Work has been spread out. I would say that there was a key person risk you had, where if that person were to leave, the city would have a tough time pulling together the financial information. I think the city is overcoming that through outsourcing some activities, through supplementing the people that are here with new hires. So it says here in the status over the past 4 years, there has been some learning where people are learning each other's roles so that there's some redundancy in the talent that's within the finance group, and workload is stabilized. And I would say that the audit procedures that we have performed would validate that status as well. So we're seeing improvements. I wouldn't say that it's in an ideal state yet, but there certainly have been improvements, and I want to recognize that. The second item there is that we would like to see the capital asset activity for all of the capital assets migrated fully and completely into Munis. That was an area this year that there was some challenges in auditing that, some complications that would be improved if everything was in one spot and there was less tracking manually through some spreadsheets with different people. So my understanding is the city does have a project plan to improve this over the next year, and a lot of effort is being put towards getting that information into Munis. So we're pleased to see that. And then finally, we do some internal control testing over billing within IPL. And through the course of doing some of that work and talking with some of the team members in that area, we did feel like that if smaller batches were done in order for that reconciliation, to do that check to make sure that the bills are going out properly, if those batches were smaller and more frequent, that would improve that control process. And again, we're seeing that that does seem to be in process. The city is having discussions around that, redesigning and updating report capabilities and so on to make that functionality improved so that the people that are charged with that process can do it more efficiently. So that really concludes the comments that I have from the audit that we completed of the city for the year ended June 30th of 2022. It was issued, the audit report, in December of 2022. There's a 6-month requirement from the year end to when the audit needs to be issued. That's driven really by your bonds, who expect the reports to be posted on a public website. So those that all those requirements were met is my understanding. The timing certainly was. So happy to take any questions anyone has about this audit or any observations anyone has.
Go ahead. So with the batches with the with our utility, is there a sweet spot that we would like to have for batches going out that would be good and productive?
Well, my observation, or our team's observation, is at a higher level. I would say that it's currently, and by currently meaning currently as we observed it during the audit, so it may have changed by now, but was being done about monthly. And we think a sweet spot would be more like weekly. That would just be, there would be less activity. If there's something that needs to be changed, they can catch it quicker. There's just less to look at. Really, it's going to be up to them and what they feel like. They know their process is the best and what feels right. But that would be a significant change going from a month to a week. Yeah. Thank you.
So, question, we get inquiries from time to time from citizens relative to, the finances of the city. Mm-hmm. And so, I'm really pleased to see essentially what I'd consider a very clean audit based on would that be your characterization?
Yes. We didn't have any significant deficiencies or material weaknesses to communicate. The uncorrected misstatements that I communicated, that adjusting entry that I communicated, those are not unusual for a city of this size and complexity. And those are not indications of errors in cash moving around. In most cases, there are differences between an actuarial report that came in on one day and another. I've used the term paper entries a few times. They're entries that are required by generally accepted accounting principles that were corrected during the process or left to be corrected for the next year, not indications of problems in workflow. They're things that can be addressed and adjusted with small tweaks to the process. So yes, I would say a good audit, okay. Good results.
The other question I'd have is, I know that in the last year or so, there's been a significant change relative to how internal funds have been allocated and things. Do you all look at that at all? Is that part of your audit or not really? Or I just didn't know if that was in the scope.
We do look at the internal, the transfers between funds and so on. Yes, we do look at that. Since June 30th of 2022, I don't know, I can't say anything that has changed since then about what you're doing with tracking funds between funds or allocations between funds. So maybe I can't really fully answer that question at this time, but through June 30th of 2022, we do look at it. Yeah.
Okay. All right. That's what I wanted to know. Thank you.
Mr. Chairman.
Go ahead.
Would it be okay to add one follow-up to Mr. Moyer's presentation?
You bet.
Okay. When I hired a new director of finance and administration 4 years ago, after his first week on the job, came to meet with me and give me his assessment. And one of the things that stood out to me was his description of our accounting division, which he described as a crumbling wall, which was terrifying as a city manager. And it was not an issue of the human talent we had. It was an issue of the lack of human talent that we had, the vacancies, etc.
I would be remiss if I did not celebrate and highlight the work that's been done these last 4 years. The team that has been hired and put in place there, the two women behind me, the director next to me, have worked very hard to shore up that wall of accounting so that we can have a clean audit, and you as our governing body can communicate to your citizens with confidence that the finances are being well managed, well tracked, and handled in the city. And that is a reflection of their work. And finance isn't always front of mind when it comes to public services, but we would be remiss if we didn't highlight their extremely incredible work here today.
Kind words, Mr. Walker, and well taken. Thank you. And thank you, Mr. Moyer. It's always our pleasure. I will not stop mentioning Karen DeLucci, so she would have been very happy. Thank you.
Okay, thank you.
Yeah. And thanks for being here in person. It's nice to get everybody back here in the same room. Okay. Star of the show. Oh, you don't understand. What you're about to update us on, Ron, are electronic timekeeping, digital timekeeping. Mr. Walker's famous stack of Xerox paper. We're excited. So please, you're up.
Good afternoon, everyone. Just to give you a brief update on the timekeeping project. So we put out an RFP at the end of the summer for a new timekeeping solution for the city. We got 6 responses, which was actually pretty good. We went through all those responses. We chose the top 3 vendors. And then we created what's called a demo script to make sure that the vendors were going to show us exactly really complex timekeeping needs, much more so than the city normally the size would have. So we wanted to make absolutely certain that they could handle it. So we have now completed 2 of the 3 demonstrations. The last one is tomorrow. I anticipate that we will be able to make a decision on a finalist vendor next month, so in February. From there, we'll probably have to do that. We'll definitely go through the diligence process. We will check references. We will go through contracts and statement of work development, go through legal review. That'll probably take a few months. So hopefully by April or May, we'll be ready to kick off an implementation. It was just going to be about 6 to 9 months. There'll be a lot of business policy review and changes the city will need to consider, because just because you're buying a solution and implementing it with the functionality you need, you're going to have to change some of the ways the city policy works with regard to timekeeping right now. So that'll be a little bit of a lift, but things are looking good right now. I think the demos have gone really well. We've had great participation. I think there are approximately 20 people from various departments in the city who are taking part in the demos. They're actually scoring with objective and subjective scoring. We're keeping all these folks involved in the project the whole time because it'll be important to have their buy-in and have them involved in the implementation. So that's where we're at right now.
Are we having fire and police and all departments involved? So,
yeah.
Oh, this is beautiful.
We have at least one from each department.
Okay.
Representing each department.
Okay. And through the first 2 demos, not that I'm trying to get early scoring or anything, but are they believed to work with Munis or whatever other software that we've got working?
That's correct. That was one of the main requirements, that not only could they integrate with Munis, but they have integrated with Munis, because sometimes Munis doesn't always play well with others. And so we wanted to make sure they had that experience, and they all did. And Cindy Gray and Holly Dreyer from payroll actually put together those scenarios. They were really complicated. We made them kind of solve those problems live, and they so far 2 of 3 were able to do it. So
Okay.
They
And
actually demonstrated it.
demonstrated it live.
okay. And how about like apps, work on phones, web-based,
All of the
Windows,
above.
anything, all that kind of stuff.
They have, so we saw some new technology. I think it's new technology, that time clocks. Your typical time clock used to be that thing that, you put the card in and punch.
Yeah.
Now it's this nice little screen. You can check in, check out, accrual balances. One is even now, you can do a breathalyzer test on it. It can take your temperature. It does your fingerprint, all kinds of fun things. So, yeah, they're getting very smart.
Wow.
Yeah. So I see your
Okay.
eyes light up.
That's very exciting. I'm just picturing Amazon's behind the development of all these, making sure you're the right person checking in for work at the factory or something.
What's nice is it's a kiosk type scenario. So those who don't have access to a computer can actually use this device. Also, there's apps on your phone, your computer, just all sorts of things that you can do with it.
So if we're looking at, do they also have, this is unrelated, but along those lines, do we have yet GPS on all our assets?
Same thing, yeah.
Police cars, IPL trucks, parks trucks?
We're working on implementing that throughout the city, but phased approach.
I didn't know, will our GPS tie into the same software? Is it all separate, or
So there
does
is
that matter?
Yeah, geofencing, yes, and it generally, but that picks up usually on the device. So if you let people, so there's lots of different ways and methodologies and technology for time capture. As Cindy was saying, you just do a PC with a web browser. You can do a mobile. There are all different kinds of like time clocks, breathalyzers, temperature, you name it. And so you have to decide what fits best for each area of the city. The geofencing actually is when you have a mobile device, you can limit where people can clock in and clock out. So based on their location that's tied to your phone. So it's not necessarily, there may be something with the AVL, but I think what we saw was tied to a mobile device. That makes sense.
Just curious. So how about for being able to like flag excessive overtime or persistent overtime or hundreds of days worked in a row or that kind of thing, which we have been familiar with lately?
We could definitely we'll be able to do some of that where you can kind of see it coming and maybe hit some thresholds via either reporting or notifications. There is some functionality. We haven't totally dove into that yet, but there's definitely some of that's there.
That would, okay, good.
They've definitely shown us reporting, a lot of reporting options. So we can, I believe the one we had yesterday was showing on a daily basis, we could go in and run a report to see who's hitting an overtime threshold.
Gotcha. It'll be, well, obviously, because you don't even see time cards now.
Right.
Only once a week or every 2 weeks or something, if that, right? So, oh no, this is a small thing, but it's like a one small step for man, but a huge step for the city of Independence. This is going to be massive. It may not be as exciting as a police station, but it's pretty big. Glad you got to come see us, Ron.
Thank you very much.
Welcome to Independence. I'm just really excited. Fellas, you have any questions? Okay, Ron. Thank you.
Thank you very much.
Yes. Cindy,
Yes.
monthly.
So we have December which is our 6-month mark. And so far, we are tracking along with the budget very well. Not a whole lot to report there. We're doing very well with the budget. Couple things we are trending a little higher in sales tax, but not a lot. Transient guest tax is also trending a little higher, but again, it's not a lot. We're fairly consistent, so we're not moving up a whole lot in the revenue streams on sales tax and transient guest tax, but we are staying above last year, so that's at least a good thing. One of the things, just to note, I compared last year's December to this year's December, and if you take out ARPA, because we didn't have ARPA this year, which was $3.1 million, we are at $287,000 ahead of last year at this time. So not a lot, but to me, that's at least a positive take out of all this, considering we don't even have ARPA funds this year. So,
Yeah. Well, and in my simpleton view, considering we're entering or partially in a recession or whatever this inflationary period is, that's actually pretty good, I think.
yeah. The one thing to note, we are down in the franchise tax, and that's mainly due to the telephone. We're doing some more deep dive into that, more on specifically, is it a particular vendor? Is it a Verizon or an AT&T or whoever it might be, to see why we're declining in that area. But that seems to be the biggest one right now. So I don't have a whole lot to report because everything is just tracking really well with budget. So.
Okay. Gentlemen?
Go ahead, John. So, as usual, I have a few questions. I'm looking at street improvement sales tax fund. I just picked a few things here, but and I just noted that the expenditures are not very much in compared to what our revenues are, and so we have a pretty significant surplus at the moment. Is that a common occurrence for this time of year, or is that I'm just wondering what that's about?
I didn't compare it to last year, but I would think the colder weather is holding the street construction projects back. So typically you'll see most of those street improvements more in the spring, when the weather is warmer. So I don't see that to be an issue. Do you have any?
Right. You'll see a contract for our pavement management program come through, probably in the next month or so, for the pavement management program of 2023. So.
Okay. All right. Next
Knock
question.
on wood. We've also had, not a lot of snow events yet.
Right. Well, yeah, don't even talk about that, right?
Hey, I was going to ask you, did they remove snow today or did it just melt off the road?
Contrary to what you may have read on social media, our roads were perfectly fine, passable. The crews went in at midnight last night, treated them with the salt brine that we put down. So temperatures did stay up, but our crews were out working overnight and had the roads. For anybody who wanted to get out to their destinations this morning, they were able to safely do so.
I was going to say thanks, but it was warm enough. I wasn't quite sure, but
No, the thanks is warranted in this case.
well, please thank staff.
Mr. Chairman, and also to add to the excellence of our municipal services, I was at work at 4 a.m. and the roads were slushy, but very drivable.
Sorry, Mr. Fierce.
No, that's fine. In Central Garage Fund, I'm looking at the change in that position line, and that's pretty negative there. And I'm just kind of wondering if there's any anybody can enlighten me a little bit on why those expenses are as high as they might be.
Yeah, so right now, the central garage, we have, if you look down at the, towards the bottom, under other net position components, there's some current year encumbrances. So right now, our operating expenses are are higher because we have some encumbrances that we are showing in the financials they're showing up in the actual numbers. So that's why we're having higher expenses at the moment because we have some POs that are still sitting out there ready to be used.
Okay, good. Last question is on the event center, and I may have asked this last time around, but golly, we got a huge unassigned fund balance in there, and I'm just kind of wondering what is normal for the event center, and is that basically there to do a lot of deferred maintenance, or just ongoing maintenance, or what? I'm just curious about that particular fund.
Well, we do a cash fund flow of our expenditures, so they build the reserve out so they can spend it. I know just recently, I believe they did some seeding, so I know they're using capital. It's just as it comes in, they start to use it.
Okay. All right. All right. Thank you.
Oh, Ms. Gray, thank you. I meant to ask you, following up on one thing that Mr. Moyer mentioned, capital assets, getting them into the munis. My COVID brain is dragging. I remember talking about that before. There's just a bunch of manual data entry. Is that where we're at?
It is. The general fund is in Munis already. It's the utility groups, and it's collecting their data and getting it put into Munis.
Okay. And they're working on that, and
We are, yes.
hopefully this year.
That would be the hope.
Gotcha. Well, we appreciate the effort. Thank you.
Thank you.
Okay. I have an older copy of the agenda, but we've got a very patient council member in the back that I'm going to go ahead at the top of the management analyst items. I'm going to go ahead and put this at the top. So, Crackerneck Creek, we are going to ask our management analyst at the request of Councilmember Steinmeier and a sort of a joint request between us to do a review, gather some materials, and I'm going to allow Councilmember Steinmeier, certainly unless there are objections, to go ahead and make a statement, talk about what he'd like Dr. Green to do on this item.
Right. And
please,
Dan, I appreciate it.
Yes, sir.
Members, I appreciate the opportunity just to, in just a little over a week, to have this added. I think, where we're headed as a city is exciting. The projects that we know we need to do and have known that need to be done, we're finally starting to talk about them, and we're wanting to know that our taxpayers and our residents, they need to know that we hear them, and public safety is a big thing. We know that, so I think we're making progressive, even aggressive moves to begin that process, which is going to require all of us to get on board with. But I think we have the start of a roadmap of the things that we need in the city, the facilities that need to be addressed and discussed, and along that parallel line of a roadmap of projects that we've got to take on. We need to have that accountability and financial transparency of the roadmap of finances. What are we looking at? How are we going to pay for these items? So if we're going to ask taxpayers to stand with us and approve major project items, which is, let's face it, it's going to require some decisiveness from taxpayers to give us the okay to spend some money. But the beauty of it is it's not going to be 7 people. It's going to be them that are going to tell us that yes, we believe in this, and we're going to work, and we want our tax dollars to go to approve these items. And when it comes to public safety, I think people are very concerned about it. So, in that, my concern has always been that when we have something like a super TIF, that as Mr. Walker said one time, and it resonates with me every time I think about it, it's the albatross around the taxpayer's neck. And we know it's out there, and we have always known it's out there, but there is revenue that I think we have an obligation to look at recovering. That's our job. And so I'm delighted that Audit and Finance has allowed all of us the opportunity to have a deeper analysis into what can be done. Mr. Walker was back in 2013. What did you call yourself? The green what?
Rookie.
The rookie. Yes, right. But I read this, and I was impressed by what you did. You laid a nice foundation here, and so at that time, I think we were looking at what was it? Do you remember, Mr. Walker? Was it 12 million? Was it 25 million? I know it was somewhere in that range.
Offhand, I don't recall, sir, and I don't want to mislead you there.
I don't want to have you say something that's not accurate. But there was, it was in 10 years we've seen it massively grow, and so I think we have a unique opportunity here as part of our strategy and the roadmap to pay for these projects. We have an opportunity to at least look at it and give it a good look. So we're just asking that you, for the third district, but not the third district as the city goes. We need to see if there's something that we can do to recover the revenues that are owed to this city, or what avenues we have to begin to put things in motion to give the city more access and control to. And these are, listen, if it wasn't this project, I think it would be something that we have to look at as a city anyway, because of the obligation financially that exists for the next 20 years plus in this super TIF. So we have an obligation to look at it regardless. But because we have this moment where we're beginning to define how we're going to, what's important to the city, how we're going to get there, and the projects that we're saying we need now, and there's many. And so I think if we are being accountable, responsible to the taxpayers, we can come and ask. And that's my heart, is just be able to ask them, knowing that we've done our due diligence. So any questions that you have, Dan?
No, not at all, Mr. Steinmeier, council member, and I appreciate that. Dr. Green, I think if you have any questions, certainly you can reach out to Councilmember Steinmeier and certainly me. For my part, for any further definition, I would say Mr. Walker's memo gives a pretty good background of sort of the lead-in, but it would be nice to have the supporting documents gathered up in one place. They'll be fairly voluminous. That was a big deal back in the day, and of course, TIF documents are big anyway. But also to get the documents that have occurred since then, it'll be nice to have the dates and the manner of payments that occurred. There were a number of payments that were made out of the general fund along the way. And I know of some correspondence that was sent. You might have to do some digging. Mr. Walker himself actually has some knowledge of those things that happened along the way. So feel free to certainly use him as a resource. He'll be more than happy to help. But we need to gather everything up in one spot, and then feel free to use your analysis skills to see if you see any sort of holes in it. Do you need a new?
Be different.
Need a different mic.
No, I got it. Thank you.
Very good.
I'll use the resources I need.
There you go.
It helps that Mr. Walker's still with us, and he can maybe give you some reference points of where he was pulling information. So hopefully it won't be a tedious task for you, but I look forward to the outcome. So council members, thank you for your consideration in this. And Mr. Walker, appreciate you helping put this together as well. So thank you, guys.
Thank you. Thank you, Councilmember Steinmeier, very much. Thanks for being here today.
Just to make sure I'm clear on what we're asking Dr. Green to do, we're asking him to pull the material together to give us a analysis of the history of kind of what has taken place up to get us to this point in time. And then are we asking him to give us any assessment as to what our opportunities are?
Absolutely.
Okay, that's what I thought, but I wanted to check, make sure I'm clear.
If he sees any sort of general opportunity in there, of course, there may be some legal analysis certainly to be had.
Sure.
But he may be able to spot something that's open and obvious.
Okay, thank you.
Yeah. Okay. Thank you very much. And I went, I think, a bit out of order, but Dr. Green, if you would like to now, if you're ready, give your fleet management report.
The fleet management report is, it's not ready.
Oh.
No, the fleet management report is actually in the hands of, well, it was in the hands of department heads. They were giving their feedback. I'm in the process of actually doing some edits. I'm also researching and making sure the information is correct. So I'm doing some assessment. I'm very close to that, and once that should be completed within the next day, and then I'll be sending it off to the city manager. Office to review, and the city councilor's office, and that report will be then ready to disseminate to you. Right after that. So we're talking about 10 days.
Okay. Well, I may have held that up too personally, but what we may do then, just to keep everybody up to speed, I know Mr. Walker's office is excited to have that sort of looked at and theoretically finalized or approved by us. So we may call a special meeting of finance just for the purpose of looking at, approving, signing off on that. If we do, it will be a very quick meeting. We'll keep you in the loop, Ms. Gray, and your staff. So, and we'll do it at a convenient time for all of us where we can just pop in and pop out and handle that business easily. Okay. So thank you very much for that, Dr. Green. I appreciate the update.
Yeah, I apologize it's not ready, but it was getting very close. But at this time, like I said, I want to make sure that I give due process to the items that came up, and make sure that it's accurately stated so I can give you a good report.
Hey, no apology necessary, sir. We appreciate the diligence and we appreciate the thoroughness. That accuracy is always going to be more important than speed. Okay.
Can I add something real quick?
Yes, sir.
Yeah. Fundamentally, I've seen the draft. Dr. Green's right. It's in department directors. Kind of there. It's a regimented process that has to be followed. But fundamentally, based on the draft that I saw, I would absolutely agree with his basic conclusion related to fleet management.
I appreciate that, Mr. Norris, and I had an opportunity to review the draft. It looked good to me as well. Of course, I don't know from the city manager's point of view whether it makes sense or not, but I certainly appreciated the work today.
Yeah, and I don't want to scoop the good doctor down there because he's got a good report coming your way, but we are in the throes of budget development right now. And fleet is a major component of our expenditures every year. So we found the report recommendations to be very helpful and thoughtful about how to become more efficient and effective in our fleet maintenance operations at the city, while also addressing what I know has become very important to the council, which are some facility maintenance needs as well. Mr. Norris is correct that generally what we've seen we're not only supportive of but excited about, and it helps begin to frame our conversations with our department directors as we head into our budget season.
No, I'm totally on board with you right there. And again, no apology necessary at all. Would rather have a fairly done, fairly timed, accurate report than something sped along. So thank you all. Okay. Next couple of things. I'm going to remove the review of the council mayor budget. I've had many discussions with folks involved in this, and we have much bigger fish to fry. So I'm moving on for that. Cross that off. Leave it alone. We're good. I have a memo, sort of. I have a list. I made you a to-do list, Dr. Green. And you will learn to love this or hate it. I'm gonna hand it out to a few select people, but there are some. Yes, my legislative head here. Oh no, I ran out. So not everybody gets one. There are at the top are sort of some of the questions I'd like answered for the item of council employees. So as you know, our budget's coming up. What we've run into as a council is the idea. We've learned that we haven't been the best, as a council, we haven't been the best employer to our employees. That includes to Mr. Walker and our clerk and the other folks that are technically our council employees, including our management analyst and other folks. We haven't been very organized. We haven't done annual reviews. We frankly haven't treated folks like an employer should. So the starting of this process, I've got some basic questions, but mainly I want to make sure we know who our employees are, make sure they're all budgeted from the right budgets, at least for the next go around. Make sure we know who they all report to, and if they have reports, that we're all just in line with who they are. And so the council then will have a chance as a body to sit back and say, well, now we know who all we are in charge of. So what process and procedures can we put in place to start annual reviews and sort of be more fair to our employees? Does that make sense?
Yes, it does.
Okay. It's really not that big a task probably,
Sure.
But if you can grab the resolutions, apparently we're supposed to appoint some of these people by resolution as well. So we need to make sure we do that if we haven't, that kind of thing. All right. So that's it. Now, IPL. And since I don't have an extra copy, I'm going to read some of these into the record. And what my plan is, Dr. Green, is for you to spend some time with these, and we can, you and I can sit down and talk in a week or two, and you can decide what order you'd like to do them in or what it makes sense to go through them in. It's a lot of work. This is going to take some time. Welcome to your new life at IPL. Okay. Briefly, this is a massive issue. This is a massive, massive issue for us. And we have some massive decisions to make as a council, as a city. It is a serious amount of stress, expense, work, worry, decision making. It is when we talk about the albatross hanging around our neck being Bass Pro, IPL is the thing not a single person can tell you exactly what to do with. So we need help. We need opinions. We need facts. We need data. And since you represent the council, you're going to help us get data for our side. Does that make sense?
Yes, it does.
Okay. So, item number A, detailed analysis of our purchase power and ownership agreements in Iatan, Nebraska City, and Dogwood. You familiar with those?
Yes.
Okay. I figured you were. Then I won't run through those exactly. I would like to see what the financials look like. I've heard a lot of rumors about how much they run, how much they don't run, what their financials look like. Facts would be really helpful, and data. I'd like to see how financially successful they are. Under B, our capital projects. Our previous management analyst was working on an analysis of capital projects at IPL. And the way we had referred to it is he was going to go back through the budgets looking for change in the couch cushion, so to speak, capital projects that had either never been started or started and not finished, or finished and, hadn't used the budget. Again, it may be needle in a haystack. I don't know. But we need to take a look at that and see if there really is budgeted money or money in reserves or money somewhere out there that we intended to spend but didn't. The next two are related, C and D. And I don't know the answer to this at all. Congress passed the Inflation Reduction Act. It affects solar power primarily, but it affects alternative energy sources generally. IPL, there is a 50 megawatt battery proposal that's pending. It's been pending for several years. We have two solar farms that I don't know what the combined megawatts are. They're not that much. 10 or 12 megawatts total. So we have some alternative energy generation that we own. We have a proposal for some pending alternative energy that might be considered capacity. I don't know that batteries are considered generation. They might be considered capacity. However, so I'm going to ask you to learn about the Inflation Reduction Act and see if there is the possibility that the City of Independence or IPL could take advantage of that in some way with some of our assets or that proposal that's out there. Makes sense? Okay, we have a massive amount of IPL reports. Some of these are a little old, and some of this is just historical data. These are probably not top priority items. These are going to be for more, obviously, background data. We have a massive number of consultant reports, most of which, or many of which, I'm more familiar with the recent ones, but most of which the council or we've completely ignored and not done. We sort of need to see which ones we've ignored and which ones we have. I think that's important because we're at the point now where we either need to start doing the things they told us to do, or we need to start doing the things they told us to do times 10, or not. Again, more background, probably not top of the list stuff. Okay. same thing on F. I'm really curious to see. I'd like to see sort of a graph almost with lines on it that shows rates, wages, and debt. I can imagine what it actually looks like, but I can guess where the lines draw to today. Okay, G. G's important. SPP, and H is also an SPP thing. So SPP is our, as you know, it's our club that we're in, and they dictate what we have to provide as far as capacity. So the council needs, I need to know exactly what capacity we have to provide and when. Exactly when. I would like it if you could find independently an SPP person or someone related to SPP or someone that's done work with the SPP that's not related to the city, that's not related to Indy Energy, that's not related to a council person, that's not related to staff. The citizens of this town don't trust any of us to come up with an opinion on IPL. If there's a chance, you can find a power expert, but somebody that's credible, somebody that is familiar with us, with the SPP, that could come and talk credibly and intelligently, sort of about our size of company, or if on off chance that they're familiar with us. That would be wonderful. I don't know how hard to ask this is. I don't know if it costs money. I don't know what that looks like, Doctor. But and I'm not asking you to go out and spend $100,000 on some expert from New York City. There are lots and lots of consultants. There are salespeople. There are lobbyists. There are consultants. There are consumer groups. There are a ridiculous amount of people that work in this industry. What I'm trying to find is somebody that can walk into Independence with some credibility that isn't tainted by any of us, that could come in and give us the most honest opinion they could on where we're at. Does that make sense?
I will do my best to find this miracle. Yes, I will do that.
It is. I know it seems a little bit esoteric, and it may seem like an odd ask, but I think if you start making some phone calls and start asking around, I think you'll be able to track some folks down. I really do. And there's a lot of people that do like to talk about power. There are. And if it doesn't work and you don't find anybody, that's okay. I mean, if this is a harebrained idea and it doesn't work, that's okay. Hey, we have to start somewhere of finding people that can come talk to us about this.
I'm happy to look into it for you.
I appreciate that. And gentlemen, Mr. Fierce, Councilman Perkins, if you have any other ideas to add to these things, now's your chance if you've brainstormed while we're talking.
I think this would be, this is a good start. Some of this, I think, will be fairly quick answers. Some of it will be, probably undoable. But I think there's a fair amount of information here that, looking back at past reports and of consultants and things that we've got in the past, some of that may be helpful, and some of it, maybe history, so
I get that.
we'll just have to take a look at it and see what we can see.
I get that.
May I suggest that there's just a lot of data that maybe have a midpoint review of findings, kind of to see what Dr. Green has found, and maybe go through that and point him into a direction that maybe we didn't anticipate, or give a review to see where he's at, maybe save him some work that perhaps as we review the midpoint work, he doesn't need to go down that one road, if that makes sense.
I think that's good.
This is quite a bit of data.
It is. It's a lot. It's a lot.
But needed, for sure.
Yeah, it's a lot.
And also to take into account, too, I mean, think of the nature of the energy business that has taken place, and the twists and the turns and the ups and the downs from 2000.
I know. I know. It's fairly back. And like I said, the 2000, those items can be pushed in the back. I mean, they can be at the end of the list. They're not nearly as pressing. In my mind, they have some value to show us. There's some value to show us how we got here and how we need to not make those mistakes again. We need to make different choices going forward. That's the big value to me in it. But yes, they can wait till the end. We have much more pressing needs that some of the other issues address currently. You have any questions, Doctor? And we can meet. I plan on setting some meetings with you so we can meet more regularly and for any questions or updates and that kind of stuff.
No problem. Like I said, I'd be happy to look into these things for the council, and certainly I'll be looking forward to getting to sit down with you and discuss these further.
Absolutely. I understand. Anything else? Mr. Fears? Okay. Where'd my agenda go? Go and sit on top. Oh, here we go. Okay, thank you. Moving on, new business. Mr. Councilman Perkins, I believe you had something.
I do, thank you. Since we've been talking about general obligation bonds and different funding mechanisms to move our city forward in the big plans and visions, I think this was probably more for the city manager's office as opposed to our auditor's office, which has just got a big list. So as we move forward looking at the obligations for a general obligation bond, what is, and help me with the phraseology, or what would be our bonding capacity? What would be a fiscal financial policy if we were to move forward and adopt a policy, then eventually a ballot initiative for a general obligation bond? What would that look like? Can you explain that to the council once you get those numbers together and be able to work through that and start this conversation so we can get that good baseline and that good foundation set?
Yeah, we would be happy to do that, and I think it's critically important that we do that, as the city does not have any general obligation bond debt and has not for some time. I think we would all benefit from that tutorial and that understanding. The deputy city manager has, in anticipation of that, has reached out to our financial advisor, Baker Tilly, so that they can start putting some of that information together, helping us understand what our limitations are and responsibilities under the state constitution, other financial best practices, et cetera. So I think we can get this pulled together in relatively short order and be back in front of this committee, and if you wish, in front of the council, and share that overview, if you would.
If I can add in, when you say short order, if we're going to have a emergency meeting, lack of a better word, could that be something that could be presented to the Audit and Finance Committee and then given to the whole body at a study session?
What I would speculate is that we can definitely have some of the, our maximum debt margin, some of those numbers, because those are just a math problem. And some of the other requirements associated with that. some of the information financially about interest rates and the city's current credit ratings and the impact on interest rates. We're at the mercy of Baker Tilly and how long they'll take to calculate some of that. I don't anticipate that being a 6-month project or something of that nature, but we can definitely have that conversation with them and let them know what we're trying to pull together. But some of that preliminary information is what I definitely feel confident we can get back to you quickly.
Sounds good.
Good question. Appreciate that. Councilmember Fears, is there anything else you would like to discuss under new business or put on the agenda for next time?
No, the only thing I'm thinking of is that we've now asked Dr. Green to, we've given him a significant task list relative to IPL. We've also asked him to look into things at the Connect Creek TIF. And if I'm sitting where he is, I'm thinking, okay, what's my first priority? What's my second priority? And down the line, I don't know if we want to give him any additional, prioritization. I mean, because there's always so many hours in the day. And so I'm just wondering, just thinking about that as if I'm.
What do you guys have? Would you like him to, the employee thing will be fairly simple. But do you want him to get the Cracker Neck Creek thing done first before he jumps into IPL?
I think so. Mm-hmm. Yeah, I think so.
Why don't you hit that, do the employee stuff, do Cracker Neck Creek, and then jump into IPL. And when you take a look at IPL, sort of prioritize that in your mind, easy to hard or shorter to longer, and then we'll get together and talk about it. Does that sound good?
Yeah, thank you.
So that we can keep it a little simpler.
Thank you.
Does that sound okay?
That's what I'll do.
Thank you. Sound good to you guys? Very good. Anything else from you, Mr. Walker, Mr. Norris, Ms. Gray?
Nothing from me, nothing from us.
Okay, next meeting. Like I said, we may do a special meeting, but we'll wait to see when we get his report back. Ms. Osborne's here, so she so is Ms. Gallman, so we can get that notice done fairly quickly if we need to. So we'll wait on that. But otherwise, folks, let's see, January. I'm okay going quarterly at this point. Everything's going swimmingly. You passed your test with Chester. You are acing the Ron Luce project. You're killing it in every way. So January, February, March, April, is that a quarter? So what would we be looking at? The week of the 20th? 26th, gentlemen, folks.
April 26th is a Wednesday, right?
Yeah.
Okay.
Wednesday at 3 o'clock.
Yeah, I can make that one.
John?
Yeah.
Is that good for you? Okay, next meeting will be Wednesday, April 26th at 3 o'clock in the IUC. If nobody has anything else, Dr. Green, does that work for you?
Yes, that's fine. Thank you.
Very good. Okay. We are officially adjourned. Thank you all. Thank you, Steve.
Thanks, man.